Okay, listen up, because big changes are coming to UK workplace pensions. And trust me, whether you're running a business or just starting your career, this is going to affect your wallet. So, what exactly is happening in 2026? Why should you care? And most importantly, what do you need to do about it? Well, we're about to break it all down for you.
Now, to really get to grips with these shifts, we brought in the heavy hitters. This special briefing has been put together with the experts at Pro Tax Accountant. These folks are on the front lines every single day, guiding businesses just like yours through these exact changes. So thanks to them, we've got everything you need to know right here. Let's dive in.
You know, since it kicked off back in 2012, the whole auto-enrolment thing has been, well, a massive success story. We're talking about over 10 million people. Just think about that, 10 million new savers funneled into workplace pensions. That's a huge number of people now building a better future for themselves, who probably wouldn't have been saving at all otherwise. It's been a total game changer for the UK, for sure.
But, and this is a big but, despite all that success, there's a hidden problem. The system as it stands right now, it's not perfect. In fact, it's leaving a lot of people behind. We're talking millions of younger workers and people on lower incomes who are just falling through the cracks. They're locked out, missing out on years of potential savings and, crucially, those valuable contributions from their employers. This has created a pretty serious pension gap, and the government is now, finally, stepping in to fix it.
So here's what we've got lined up. We'll look at that hidden pension gap, then dive into the big 2026 shakeup. We'll see who's going to start saving, crunch the numbers on the financial impact, and wrap up with a solid action plan for you and how to get expert help right away.
So, what's the big plan to fix this? Well, it all comes down to the Pensions Act of 2023. This legislation is bringing in two absolutely fundamental changes in 2026. And I'm not talking about small tweaks here. This is probably the biggest shakeup to auto-enrollment since the whole thing began.
On the surface, the changes look pretty simple, but believe me, the impact is going to be huge. So, change number one. The minimum age for being automatically enrolled is dropping from 22 all the way down to 18. This is huge for getting a new generation of workers saving from day one. And number two, the lower earnings limit is being scrapped. Gone. Right now, you only contribute on what you earn above £6,240. From 2026, every single pound you earn will count towards your pension contributions. Okay, so these changes aren't just about numbers on a spreadsheet. They're about real people, millions of them, who are now going to start building a proper retirement fund. So who are we actually talking about? Let's meet the new savers. First off, we're talking about millions of young people. Just picture it. A 19-year-old barista in Manchester, maybe starting their first proper job. Under the old rules, they'd have to wait 4 years. 4 years before they'd even be considered. Now, they're in from day one. It's also a game changer for lower earners and part-time workers. Think about a freelance graphic designer in London, juggling a few different clients. Before, they might not have hit the earning threshold with any single one of them. Now, every pound from every single job starts working towards their future. It's a massive change. So, why is starting a few years earlier such a massive deal? Well, just look at these numbers. It's all about the magic of compound interest. For your average earner, just starting at 18 instead of 22 could mean an extra £20,000 in their pension pot by the time they retire. 20 grand? That's the power of giving your money more time to grow. Those 4 extra years make an unbelievable difference over a lifetime of saving. Right, so we know who's going to benefit. But what does this actually look like in pounds and pence? Let's get down to the nitty-gritty of how this is going to affect pay slips for employees and, just as importantly, the bottom line for businesses. This is where the details really matter. To really get this, we need to talk about something called qualifying earnings. It sounds a bit technical, but it's simple. Right now, for the 2025/26 tax year, pension contributions are only worked out on the bit of your salary that's between £6,240 and £50,270. By getting rid of that lower limit of £6,240, it means your entire salary, right up to the cap, becomes pensionable. In simple terms, more of your pay is now going to be used to calculate both your pension contributions and your employer's too. And look at the difference this makes. Let's say you earn £25,000 a year. As things stand, only £18,760 of that is actually used for your pension calculations. But from 2026, the whole £25,000 is used. That's more than £6,000 extra of your salary that's now working for your future. And that means bigger contributions from you and, yes, bigger contributions from your employer.
Okay, let's make this super practical. Let's stick with that person earning £25,000 a year. What does their monthly payslip actually look like under the new rules? Well, it all kicks off with their own contribution.
So at 5% of their full salary, their monthly contribution is now going to be around £104. That's their investment going directly into their future nest egg.
But here's the best part. They are not saving alone. Next up, their employer chips in their 3%, which works out to £62.50. This is basically a pay rise you don't see on your payslip that goes straight into your retirement pot. It's free money.
And it gets even better. Don't forget the tax relief from the government. They top it up with another £20.83. It's another free bonus, straight from the tax man, just for doing the right thing and saving.
So, you add it all up. Your bit, your employer's bit, and the government's top-up. You're looking at over £187 going into that pension pot every single month. That, right there, is how you build a serious retirement fund over time.
Right, we've seen the numbers for employees, but what about the business's footing part of the bill? How can you manage these extra costs? Well, this is where the expert insight from Pro Tax Accountant really comes into play. Stay with me here because this next point is absolutely crucial for any business owner.
Let's talk about something called salary sacrifice. It sounds complicated, but it's not. It's basically an agreement where an employee agrees to a slightly lower salary, and in return, the employer pays that exact amount straight into their pension. So why on earth would anyone do that? Well, here's the genius part. It can lower the national insurance bill for both the employee and the employer. Those savings can either go back into the employee's pocket as more take-home pay, or you can chuck them into the pension pot to boost it even more. It's a genuine win-win and a really valuable perk to offer your team.
Okay, so we've covered the what and the why. Now for the really important bit, the how. Especially for employers, getting ahead of this is everything. So let's switch gears and walk through the clear, actionable steps you need to be taking right now to get ready for 2026.
Here it is, your 4-step action plan. Step 1, review. Get into your payroll system right now and figure out who's going to be newly eligible, especially all those 18 to 21-year-olds. Step 2, budget. Start modeling these increased employer contributions and get them into your 2026 financial forecasts. No surprises. Step 3, communicate. You need a plan to explain these payslip changes clearly to your whole team so everyone knows what's going on. And finally, step 4, check. Get on the phone with your payroll provider and make absolutely sure their software is up to date and ready for these new rules.
Phew, we have covered a lot of ground. So let's just pull back for a second and nail down the absolute key takeaways from all this.
Okay, here are the 4 things you absolutely need to remember. First, the minimum age for auto-enrollment is dropping down to 18. Second, pension contributions will now be calculated from the very first pound someone earns. Third, this is amazing for millions of savers, but it does mean costs are going to go up for employers. And that leads to number 4. Proactive planning is the only way to handle this smoothly. Do not wait until the last minute. And honestly, this really sums it all up. For any business out there, the difference between a smooth, seamless transition and a chaotic mess later on is the action you take right now. The businesses that are going to navigate this successfully are the ones that start preparing today.
Right, just before we wrap up, a very important note. The information we've shared in this briefing is for general guidance only. It's really important that you don't rely on it exclusively to make any financial decisions.
For advice that's actually tailored to your specific business and to really dig into smart options like salary sacrifice, you absolutely need to speak with an expert. We can't recommend the team at Pro Tax Accountant enough. You can reach them directly on WhatsApp or by phone at 07985 689912. Again, that's 07985 689912. Or you can just drop them an email at info@protaxaccountant.co.uk. They are ready and waiting to help you get prepared. Thanks so much for joining us.